Good morning. Welcome to my YouTube channel. I would request you to please press like and subscribe so that you can get all further notifications of all videos that I'll be uploading on my YouTube channel. Today, what we are going to talk about is your money safe? COVID-19 is the biggest pandemic that has hit the planet Earth in the last 100 years. It's caused the maximum economic devastation in the last 80 years. So in terms of the Indian market, is your money safe as far as equity or the debt side of the market is concerned? Looking at the equity side of it, the market went down in March by about 39%, almost 40% destruction, value destruction in terms of the equity market happened in March. We hit the lows on the March 23rd and 24th. April has been a fantastic rebound in which we've had 32% recovery as far as the broader market is concerned. Well, what does that imply? Are we out of the woods? Not really. There is tremendous amount of volatility as far as the equity markets are concerned, and investors should be really wary as far as investing in the long term is concerned at this juncture. The debt market is very badly hit as well. The biggest problem of the debt market has been the liquidity issue. There are lakhs of investors that were caught on the wrong side when a leading mutual fund, Franklin Templeton, decided that 6 of its mutual fund schemes, the credit risk schemes, were really wound up. With 25,000 crores under assets under management, the scheme, all these 6 schemes were really wound up as far as Franklin Templeton were concerned. Now, what does this really imply as far as investors at large are concerned? Is this a problem that is only pertinent to one mutual fund, Franklin Templeton, or is this a systemic problem? Let's try and understand this a little better. If you look at Franklin Templeton, when you wind up a scheme, what does it really mean? It really means that the investor cannot really withdraw its money, nor can he do a systematic transfer, nor can he use the mutual fund unit as a collateral to take certain leverage, which could be against given to a broker for stock market as margin. It cannot really happen. So the trustees come into play. They will ensure that the schemes are wound up. When the schemes are wound up, as and when the money flows in, as far as the scheme is concerned, it would be returned to the investors. So is all money lost? Answer is no, all the money is not really lost. How long will it take to really recover? The duration could be anywhere between 6 months to 12 months for a complete recovery as far as the funds are really concerned. Will you get 100% of your funds? Answer is no. There would be a haircut in terms of the amount of money that you really get back. How much haircut would really depend on the kind of environment as far as the debt markets are really prevalent in the near future. It's a very difficult thing for a very known and experienced mutual fund like Franklin Templeton to really wind up the schemes. The biggest reason that they chose to really wind up the schemes is so that all the investors have that parity. What happens is, due to the illiquidity in the market, when there is a redemption pressure, there are 2 options that a fund manager has. One, borrow money, that is borrow against the assets under management he has, or second, liquidate some part of the holding. Now let's go to the first part of it. As per SEBI guidelines, 20% can be borrowed. So total within these 6 schemes, 5,000 crores was what the exposure as far as the total borrowing was concerned. However, there was tremendous redemption pressure that the fund was facing. And what would really happen if the schemes were not wound up? 2 things would happen. One, the savvy investors, or really institutionally savvy investors who really put money in this credit risk funds, would really have got the money, leaving the retail investors really left in the scheme, which would result in value destruction. Because when these debt securities would have been sold at inappropriate values, at great discounts, the NAV, the net asset value that would realize as far as the remaining of the fund would be concerned would be extremely low. Hence, Franklin Templeton decided that in order to give parity to all investors, institutional as well as retail, in best interest, it is really looking, let's wind up this, the overall schemes are concerned. Well, would this happen to the rest of the market? Answer is, overall, the debt market in India is really safe. What investors should really look at is really look at the quality of debt paper that your mutual fund or your direct investment holds. when you look at a credit risk fund, what exactly is a credit risk fund? Mind you, a credit risk fund also invests in liquid securities as well as AAA paper. Almost 25 to 30% of the investments are in AAA to liquid securities. Hence, all of the constituents as far as credit risk fund is not really risky. Please remember, it is not that the specific mutual fund, the schemes that were wound up had bad quality of debt paper. The problem that was really there was the problem of liquidity. So when you go to the market, and try and sell it, you would get inappropriate values resulting in value destruction, which the fund did not really want. Well, when will you get your money back? If you look at it, 5,000 crores was really the borrowing as far as the 6 schemes are concerned. So as and when redemptions of these debt securities happen, the first thing is these 5,000 crores will be returned back to the lenders. After this 5,000 crores will be returned back to the lenders, in proportion wise, the scheme holders would really get their money really back. Well, what does it really say? It really says that, there is buyer beware. You should really be aware of what you're really investing in. Does this really imply that the non-banking financial companies or housing financial companies are not safe? Well, not really. If you look at the net worth of all the non-banking financial companies and housing financial companies in India is concerned, it's approximately 9 lakh crores, against which they have advances of about 33 lakh crores, give and take advances of about 33 lakh crores. Similarly, the net worth of banks is about 13.5 lakh crores, against which they have advances of about 97 lakh crores. So what does it really imply? That every rupee that the NBFC is really lending, 27% is core capital. So the question is, it is not that the NBFCs are not well capitalized. The NBFCs and housing finance companies are very well capitalized in this country. The problem is really liquidity that is happening at this juncture. We've seen that the government has given a lifeline. The government and RBI has given a lifeline. RBI said commercial banks can borrow from a special window and under the TLTRO window, and they can avail a facility which they can give mutual funds. However, the banks are very averse in terms of overall credit situation. And unless and until loss is really guaranteed, we've seen that this kind of surplus liquidity will not be passed on. Today, banks are sitting on 7 lakh crores of liquidity. However, if we really realize in practical terms, credit offtake is not really happening. I'm sure and very confident that the Reserve Bank of India and Government of India would come out with appropriate measures to ensure that there is adequate liquidity so that it doesn't lead to a solvency crisis. However, please remember, that is the message I'm trying to drive, is beware when you make investments. Please remember, investing is not an entertainment, nor is it a sport that you can really think, you can really participate in. It is extremely a serious business. And when you make an investment, please ensure that you approach a proper financial advisor that would really give you appropriate financial advice on what the overall environment is, especially in this period where there is going to be abundant volatility in the market. Both the debt side as well as the equity side is really going to fluctuate over ups and downs. So please, buyer beware. And remember one thing, investing is a real serious business. India will do well because it is the biggest democracy in the world, and a lot of capital will be drawn in the long term. But if you survive as far as 2020 is concerned, then you will thrive in terms of business and overall portfolio is concerned. Thank you so much.